Have you ever wondered if the numbers you see on your screen actually represent something that exists in the physical world, or if we are all just participants in a massive collective hallucination? It is a psychological truth that humans trust what they see in their bank apps and brokerage accounts more than they trust the ground beneath their feet. But what happens when the two stop matching? What happens when the digital reflection of wealth begins to move in a different direction than the physical atoms it is supposed to represent? We are standing at a very specific crossroads this week. It is mid-December 2025, and while the world is distracted by the usual end-of-year noise, something quiet and profound has happened in the vaults beneath London and New York. If you look at the surface-level data, you see a market in flux. But if you look at the movement of the metal itself, the actual heavy silver bars, you see a system that is gasping for air. Let's start with the hard numbers. Last week, the iShares Silver Trust, known by its ticker SLV, saw its holdings drop by 37 tons. On the surface, this might seem like a rounding error in a global market, but in the context of what has happened throughout 2025, it is a flashing red light. Despite this weekly loss, SLV is actually up by 1,690 tons year-to-date. This tells us that investors have been pouring into the ETF all year. They are hungry for silver, but the trust is now sitting at 16,066 tons, and for the first time in over 5 years, we are witnessing a physical migration that should not be happening in a healthy market. 37 tons were withdrawn from the JPMorgan vaults. This isn't just a withdrawal, it is a shift. For the first time since 2020, we are seeing silver being moved from New York to London. To the average observer, this is just logistics. To a market analyst, this is an emergency. Moving physical silver across the Atlantic is expensive, slow, and risky. You don't do it unless the destination is facing a liquidity crisis. London is the heart of the global physical silver trade. If silver is being vacuumed out of New York to plug holes in London, it means the London Bullion Market Association, the LBMA, is running dangerously low on the good delivery bars required to settle trades. Why is this happening now? To understand the why, we have to look at the how. How is the market currently accounted for? This year, the LBMA has come under scrutiny for how it defines free float silver. They include the silver held by ETFs, like SLV, as part of the silver that is available for the market. But that silver isn't available. It belongs to the shareholders of the ETF. By counting it as free float, the institutions are making the supply look much larger than it actually is. They are essentially counting the same bar of silver twice, once as an investment for the person who owns the ETF share, and once as available supply for the industrial market. In December alone, we saw an influx of 492 tons into silver ETFs. This ETF Avalanche is creating a paradox. As more people buy the paper silver to protect themselves from inflation, the funds are forced to source the underlying physical metal to back those shares. This is putting immense pressure on a supply chain that is already broken. We are currently facing a global silver shortage of 215 million ounces. This isn't a projection. It is the reality of 2025. Think about where that silver is going. Most people think of jewelry or coins, but the real story of 2025 is the hidden industrial demand. This year, we discovered that the silver loading in high-efficiency TOPCon solar cells was nearly 30% higher than initial industry estimates. We also saw the rise of silver-zinc battery technology in premium smartphones, a little-known fact that has quietly added millions of ounces to the annual demand. Silver is the most conductive element on the periodic table. In a world obsessed with AI and high-speed computing, you cannot replace it. Every H100 GPU, every server farm, and every satellite launched this year contains a piece of that 215 million ounce deficit. Now, let's look at the short positions. According to data from Fintel, short positions on silver have fallen to 43.6 million shares. On the surface, this looks like the big players are backing off. But why are they backing off? They are backing off because they can no longer defend the price. When you are short, you are betting the price will go down. But when the physical metal starts moving from New York to London in 37-ton chunks just to keep the lights on, the shorts realize they are standing in front of a freight train. This is driving the price toward the $75 mark. And here is where the psychology of the market gets interesting. In a normal market, higher prices should discourage buying. But in a shortage, higher prices attract investors because they signal that the asset is becoming unobtainium. We are seeing the death of the claim that paper assets can trade at 150 times the value of physical assets. For decades, the silver market has been a paper market. For every 1 ounce of physical silver, there were 150 ounces of paper silver traded on the exchanges. It was a beautiful system of leverage that allowed banks to keep the price suppressed. But leverage works until it doesn't. When the owners of those paper contracts start asking for delivery, when the solar companies, the tech giants, and the sovereign wealth funds want the actual bars, the 150-to-1 ratio becomes a suicide pact for the exchanges. You cannot settle a contract for a 1,000-ounce bar with a digital PDF if the customer wants the metal. The 37-ton shift from JPM's New York vaults to London is the physical manifestation of those paper promises being called in. Let's talk about some of the unusual facts that have emerged this year. Facts that the mainstream financial press has largely ignored. Did you know that in 2025, for the first time in history, several small-scale electronics manufacturers in Southeast Asia had to halt production, not because of chip shortages, but because they couldn't secure the silver paste needed for circuit boards, or that the U.S. Mint has quietly moved to indefinite allocation for Silver Eagles, meaning they are only producing a fraction of what the market is demanding. There is also the silver recycling gap. Many analysts thought that as the price of silver rose, more people would recycle their old electronics or jewelry, bringing supply back to the market. But that hasn't happened. Why? Because the silver in modern electronics is so thinly dispersed that it is currently not economically viable to recover it unless silver is well over $100 an ounce. This means that the silver used in technology is consumed. It is gone. It isn't like gold, which is almost always recycled. Silver is being buried in landfills inside old phones and laptops at the exact same time that we are trying to build a green energy revolution. The pressure on the COMEX free float is reaching a breaking point. The term free float refers to the silver that is actually available for delivery, not spoken for by a long-term holder or an industrial contract. As the ETFs continue to suck up hundreds of tons a month, the amount of silver available to grease the wheels of the daily trade is vanishing. We are watching a slow-motion car crash in the world's most important industrial metal. As we look toward the end of December, the $75 target isn't just a number on a chart. It is a psychological barrier. Once silver breaks through that level and stays there, it confirms to the industrial buyers that the days of cheap silver are over forever. They will move from just-in-time inventory to just-in-case hoarding. If you think a 215 million-ounce deficit is bad, wait until Apple, Tesla, and Samsung decide they need to hold a 5-year supply of silver in their own private vaults. We are not talking about a speculative bubble. We are talking about the basic laws of physics and chemistry. You can print $1 trillion, but you cannot print a single atom of silver. You can move 37 tons from New York to London to cover a shortage, but you can only do that so many times before the New York vaults are empty too. The shift we saw last week is a signal that the global game of musical chairs with silver bars is reaching its final few seconds of music. The data from the SLV Trust, the Fintel short interest reports, and the LBMA vault audits all point to the same conclusion. The paper market is losing its grip on the physical reality. The ETF Avalanche is no longer just an investment trend. It is a vacuum that is clearing out the last of the available bullion. This isn't about panic. It is about preparation. It is about looking at the 16,066 tons left in the trust and realizing that in a world of 8 billion people and a massive industrial deficit, that is a very small amount of metal. As the price approaches $75, the questions we started with become even more urgent. Do you own the metal, or do you own a promise? Is your wealth in the atoms or in the digital pixels? The movement of those 37 tons across the ocean tells you everything you need to know about which one the banks value more. They are moving the atoms because the pixels are no longer enough to satisfy the market. This is a story that is still being written, and the next few weeks into January 2026 will likely be the most critical in the history of the silver market. The decoupling is here, the shortage is real, and the vault doors are starting to creak under the pressure. Subscribe and leave a comment.